Want to make sure this works. Oh, it does indeed. Okay. Thanks everybody for coming. First, I just want to thank Richard Jacobs for inviting me down here to Dallas to give this presentation. But first and foremost, let's all thank Satoshi Nakamoto wherever they are. Okay. So, I don't know. I just thought I'd give you a quick thing about, what am I doing in this space? I'm an accountant and I'm in crypto. Look, I'm here because blockchain is revolution, and this is the single biggest innovation in finance of our lifetime. And I get to have the fun of seeing what all you guys do with all these different trades and transactions. Okay. Just a quick bit about what my company does. We are global tax accountants. And essentially, we provide cryptocurrency tax and accounting services for ICOs, traders, miners, and other investors in the cryptocurrency blockchain space. We'll calculate all your crypto income. We'll do your tax returns. We also deal with a lot of foreign tax issues because these just tend to be prominent. There's a lot of exchanges outside the U.S., and these issues do tend to pop up. We work with companies as well as individuals. We do some other neat stuff. If you're a high volume crypto trader and the existing tools can't deal with your trades, we can do a custom solution for that. And we also do a bit of what I call cryptocurrency forensic analysis, which essentially means going through all of the records for a particular individual, for their exchanges, their wallets, what have you. You're using a decentralized exchange. We'll drill down to an Ether wallet and using Etherscan if we need to, in order to figure out what all this stuff means for tax. Needless to say, we do accept Bitcoin, Ethereum, and I'd consider another major token, depending on the state of the market. So I'll just start with some key facts about crypto and tax. The most important thing to consider here is that, according to the IRS, Bitcoin and virtual currency, I'm just going to go here so you can see, this is a type of property. Bitcoin is not a foreign currency, and that makes a large difference in the tax realm. You have income on a day that you sell or exchange Bitcoin, you mine the coin, or you receive Bitcoin in exchange for goods or services. It's extremely important to keep in mind that cashing out to USD or any other fiat currency is not the only event which triggers tax. Tax is triggered by converting Bitcoin to USD, any fiat currency, goods, services, or other property, which includes other cryptocurrencies. So everything that we know from the IRS in regard to taxation of Bitcoin was put in one notice that was issued in March of 2014. And I kind of just wanted to start the meat of the presentation by throwing out the definition of what is a virtual currency for the IRS. A virtual currency is a digital representation of value that functions as a medium of exchange, a unit of account, and or a store of value. Virtual currency that has an equivalent value in real currency and that acts as a substitute for real currency is a convertible virtual currency. That's a little verbose, but the bottom line is Bitcoin is a virtual currency. The notice also goes on a bit to explain what is the IRS conception of a real currency. And per the notice, that would be the coin and paper money of the United States or any other country that is designated as legal tender, circulates, and is customarily used and accepted as a medium of exchange in the country of issuance. Okay, they're talking about fiat. Okay, that's what they mean, fiat currency. We can go on a lot about philosophical discussions of what really constitutes a currency, but this is what the IRS says about what's a virtual currency and their idea of what is a real currency. Real currency is actually a weird term. It's the only time I've ever encountered this, in fact, in the tax world. It's odd it's there, but that is what they said. Okay. Again, drilling down further. Sorry. Bitcoin is property. And I'm going to say Bitcoin throughout this presentation, but we all know there are hundreds of different coins out there. So when I say Bitcoin, I may as well be saying Ether, Litecoin, Doge, Monero, what have you. If it's a crypto asset and it's being traded, they're treated the same way. So Bitcoin is treated as property for federal tax purposes. And general tax principles that apply to property transactions, they also apply to transactions using Bitcoin. Again, Bitcoin's not a foreign currency, and the fact that Bitcoin is treated as property rather than foreign currency really makes for a lot of complicated accounting problems for an average person, beginning with the coffee problem. Okay? Let's say that we do achieve a nice state of mass adoption of cryptocurrency in the United States. Okay? In this scenario, you take your Bitcoin Cash, whatever that thing is, you buy a coffee for $4.12. Well, since that's property, you're actually supposed to treat that as a taxable event and put that down on your tax return. Okay? Guess what? Nobody's doing that. Okay? Nonetheless, the requirement's there. There's no minimum reporting requirement. There was a bill introduced last year to institute a de minimis threshold. Nothing happened. And at the end of last year, Congress passed the biggest set of changes to the U.S. tax law in the past 20 years. Nothing in there about virtual currency. No changes in this respect. Okay. So what if you're selling goods and services for Bitcoin? What does this mean? Well, if you receive Bitcoin as payment, those are your revenues. And your revenue is equal to the US dollar of the Bitcoin on the day of receipt. The IRS speaks dollars, that's it. So whatever Bitcoin transactions occur, we need to look to the US dollar value at that time in order to properly report that income.
Any time of the day?
Yeah, the question of what rate do we use, right? What it comes down to is, you're right, it's incredibly volatile. Okay, so usually it's not material enough to matter. Sometimes it is. Hey, look, I mean, how many days have we seen recently where it moved 10% either way? In practical terms, when we are going through records from exchanges, we've got a price feed and we're going to use an average rate. Nonetheless, there are circumstances under which if someone can show that a particular transaction occurred at a particular rate, say, we look at the facts and circumstances. So what I'm saying is we're generally going to use an average rate. There's a number of different sources to get this. But yeah, volatility is a real issue. Yeah, which is why people are building stable coins, but that's another presentation. So by the same token, if you pay expenses in Bitcoin, you book them as the dollar value on the day of payment. It's just the other side, always going back to dollars. If you use a payment processor and you simply convert the crypto to dollars, you're not going to have to deal with any gain or loss. You just book the dollar value of this. If you instead hold your Bitcoin because you're bullish, like many people in this room, and you think it's going to go up, well, you book your dollar value of your revenues, but you now have a capital asset with a cost basis, and when you later sell or otherwise convert that crypto, you'll need to book a gain or loss. I would kind of like to mention in this scenario that if there's a company and they're paying an individual contractor, the usual rules for 1099s do apply. So if that payment to that individual was more than $600, you will have to file a 1099 for them. I've filed these forms for clients, and just last week someone sent me a 1099 because they paid me an ETH. Yeah, and I held it. What about mining? Okay, mining is another topic that was addressed in the IRS notice. So let's say you're this sort of proverbial miner in your basement, you've got some Bitmain S9s or what have you, and they're running in your basement. Your income is equal to the USD value of the Bitcoin that's mined on a given day. So you take the amount of Bitcoin or other coin that was mined, you multiply it by that day's rate, and that is your income. Okay, that's really a small scale. I like to note in this scenario of an individual that similar to other income you receive as a contractor, that the net income from the mining, you do have to pay self-employment tax. What that means is if you end up with, I don't know, had a great year, $100,000 net income, you pay ordinary income tax plus approximately 16% self-employment. And that's what the IRS has said about mining. On the other hand, if the activity rises to the level of a business, the USD value of the Bitcoin mined, those are your revenues, and then you'll have the normal deductions for your expenses. So basically, if you're a miner, what to calculate your revenues, you look at the amount of the amount of a coin mined on a given day, multiply it by that day, then do the same thing for every day of the year, and now we know what your revenues are. Okay, what about trading, which is where I get most of the phone calls that have been coming in. Mining is really important. After all, that's where we're starting. That's where the coins are issued from those 12.5 Bitcoins out of the block reward. So for most taxpayers, Bitcoin is a capital asset. This is treated, a sale of Bitcoin or any crypto is treated the same way as the sale of a stock. If you're a company that's in the business of selling Bitcoin, you would treat this as inventory. But basically, we're talking about exchanges, and that's a whole other category. So here's a simple example. You buy one Bitcoin for $8,000. 1 month later, it's now worth $10,000, and you sell it and you receive $10,000. $10,000 proceeds less your $8,000 cost. You've got a $2,000 capital gain, which is going to be short term in this case. This is an easy example. The reality is immensely more complicated. Most people don't just buy one coin and then sell it and they can easily match it. What really happens is people buy coins over here, then they move it over here, and then they take the Bitcoin and buy 19 different alts, okay? And maybe not 19, but a lot, okay? But it gets complex very quickly. It gets complex very, very quickly, but that's kind of part of the fun. But the basic principles remain the same. The challenge is to get all this back to USD. So again, this we're talking about capital gains here. In like a stock, we need to look at long-term and short-term rates. If you own a coin for more than a year, your holding period is going to get you a long-term capital gains rate. That rate is usually 15%. At the top income bracket, that goes to 20 plus another 3.8 of a net long-term capital rate of 23.8% on long-term. If it's a short-term gain and you sell withholding for less than a year, last year you had ordinary income rates up to 39.6%. The rates changed this year. The regular income tax rates did drop. The top rate is going down from 37%, and they expanded like the amount of income for the different rates, the bands. But capital gains rates did not change, so there has been no change to that. Okay. I get a lot of people asking me, what happens when I have a crypto-to-crypto exchange? And if I own Bitcoin and I buy Ether or some other token, do I really have a taxable transaction? My answer is you certainly do. Okay? If you happen to be an attorney and you've got a legal opinion, tell me 1031 works, I'd like to see it. because so far I've not seen that. So a 1031 like-kind exchange, it's a part of the tax code that was put in to apply to real estate transactions. And under the right circumstances and following the right timetable, if I take property A, I can then exchange it for property B. The tax on that gain is deferred to such time as property B is sold. So that works great for real estate, doesn't work for cryptocurrency. I found a number of different IRS rulings on the topic, and the key issue here is, does this property that's being exchanged have the same nature or character? And essentially, every virtual currency's got a different nature or character. Ether is not Bitcoin. Doge is not Monero, is not Zcash. These are separate, distinct blockchains. Each one of them have their own different characteristics. Therefore, I do not believe, and very few people seem to feel this way, that a like-kind would work. But just to drill down in details real quick, there was a ruling where the IRS looked at the exchange of different types of coins. There were gold numismatic coins. They were exchanged for South African Krugerrands. And the IRS said, this is not like coin. The bullion was valued purely on the weight in gold, but the numismatic coins were valued not just on the weight, but also the condition of that particular coin. They said it's not like kind. The next thing kind of reminds me of exchanging Bitcoin for Litecoin, okay, kind of gold and silver. And they decided that if you take gold bullion and exchange it for silver bullion, it's a different metal, different coin. This is not a like-kind exchange. The last case I found that is where you had actual currency, Swiss francs, that were being exchanged for U.S. gold coins. And again, the IRS said that this is not a like-kind exchange. The summary of the case is that Swiss francs are a circulating currency. The character is different from gold coins. They're valued for their numismatic value. Currency could not have the same nature or character as metal coins. So that's about all I want to say about that, except that as of January 1st, they changed the tax code, and 1031 now applies only to real estate transactions. So if it ever was an issue, it's closed now. Maybe, yeah. Yeah, sorry, maybe someone give them a mic, but you're saying you have a farm and you exchange it for another piece of property? The answer is yeah, that might work. I hear it. Again, if you find a legal opinion stating that this section applies to cryptocurrency, please tell me and I'll read it. I'd love to. I'm open to discussion, sir.
Dan, are you going to touch on last in, first out versus first out?
Okay, what we're talking about here are different methods to treat the sales of cryptocurrencies. Yeah, sure, we can talk about that. Do you have a particular question? Or you just want me to explain what they are, or?
Well, I know what they are. Maybe not everybody in the room does, but what I'm seeing is, and I'm not a tax person at all. I just get the bad news.
Mm-hmm.
That there's a significant calculation, and also procedurally, how most people that trade regularly,
Mm-hmm.
they trade really more. Most folks I talk to, it's really more of a last in, first out. You may have a longer term hold, but then
Mm-hmm.
you bought this on Tuesday, you sold it on Friday, but you still got what you bought in January, and you may not sell it again until November or 2020. So in real life, a lot of transactions happen last in, first out. Is there any guidance around the yes, but the IRS says you have to calculate first in, first out? Or is there any guidance?
Yeah, let me just sort of first kind of explain the background here. So in the first in, first, so what we have here is a fungible item, okay? A Bitcoin is a Bitcoin is a Bitcoin, okay? And so you've got a pool of these Bitcoins, and they were each purchased at different points, and perhaps you've also moved them around through time and cycled through different wallets and exchanges. Okay, so when you sell a particular Bitcoin today, the issue is how do you treat the pool? If you use a first in, first out method, it assumes that the oldest coin that you have is the one that was sold today. Now, in an atmosphere of rising prices, which is absolutely the way things have been, that results in higher income, right? Because the older coins have a lower basis and a much higher one today. In a last in, first out method, it's the opposite. It assumes that if I sell a coin today, if the newest coin I have I bought last week, that's the one that was sold. And it's the difference methods are going to have very dramatic effects on income, extremely. It's a little unclear of this stuff, frankly. I'm kind of in the middle of these issues. A default treatment is first in, first out, okay, which is going to result in more income, but also probably more long-term capital gain, which is going to get you a lower tax rate. If you go to LIFO, then that could mean that, in fact, that's the amount of income, more of it's going to be subject to short-term rates. But you kind of can't be, you really can't pick and choose. In other words, if you got different lots, consistency, as always with accounting, consistency is really important. It's also kind of hard to segregate coins. For most people, their stuff is, shall we say, scattered. And the simplest thing to do, and particularly from a software perspective, is to just treat this as one big pool, okay, and then apply the same method for all of them. And I can even drill down and treat different coins differently, but that's generally what I do. Nonetheless, if you're flipping from one method to the other from year to year, again, I don't know of any guidance. Basically, there's nothing saying this is what you need to do for cryptocurrency.
And that was really my question. So I'm not suggesting
Sure.
moving back and forth by pair.
Okay.
For example, for most people that traded regularly through 2017, last in, first out is going to be much more advantageous from a tax liability standpoint
Yes.
than first in, first out.
Absolutely.
So if you file based on generating your taxable revenue on last in, first out for 2017 when you file your taxes, the IRS or somebody else is going to come back around and say, we know what you're doing.
I mean, I can't predict what their IRS response would be. I can say you can do it that way.
Is there anything that would be, in your experience, where you would be at a higher probability for, since there's no guidance currently, is somebody going to circle back around and say, no, we know why you did this, it was a bull year, yeah, we get it, but you need to be first in, first out?
Yeah, you're assuming a little bit too much analysis on the side of the IRS.
Which I may be, perfectly
Yeah, yeah.
to concede, I'm happy to concede that.
Yeah, no, but it's a great question. Someone else, similar thing, or?
Yeah, sort of related. So do you have to declare that you hold cryptocurrency if you haven't sold any, and you've been holding it for a while? So I just filed my regular tax return, and I've had the same accountant for many years, and I didn't tell him that I have cryptocurrency, that I'm holding it, because I haven't sold any of it.
Okay.
He knows nothing about cryptocurrency.
Okay.
So am I doing the right thing by not declaring that I'm holding cryptocurrency until I sell it?
What I can tell you is this, is you don't have a capital event until you exchange your cryptocurrency,
Right.
Whether that's for dollars, another cryptocurrency, goods or services. So
I have, though, in the time that I've held I started with Bitcoin, and I traded Bitcoin for other currencies.
You sure you want to talk about this in front of the whole room?
So that's my question.
I think your question might go back to what I was saying. The answer is that when you convert, when you have an exchange from one cryptocurrency to another, it's going to be a taxable event, and we need to look to see what the U.S. dollar value of that was at that time. And that's what I've been doing for the last 3 years.
Quick question.
Yes.
Does it matter where the exchange happens? In other words, if the exchange happens overseas?
Nope. Doesn't make a difference. U.S. citizens and permanent residents are taxed on worldwide income, so it does not matter if the exchange happens outside the United States. I'm going to hit one important thing about that at some point. How are we doing on time? Where's our timer? We're good? We're good. But yeah, U.S. citizens are taxed on worldwide income. So there are a lot of exchanges located outside the United States. And it really doesn't matter that those transactions happen outside the United States. The important thing is, so regardless of where these transactions occur, that they need to be reported on your taxes. And you may need to do some other filings as well, which I will get into in a bit. So, somebody in the back, standing? I do. You want me to say what it is? Oh, wow. Okay, that's a pretty technical thing. So, Bitcoin last year forked into Bitcoin Cash. Then it went into Bitcoin Gold. Then it went to Bitcoin Diamond, and a bunch of fairly useless alts that nobody held for longer than it took to dump them on the nearest exchange. Okay, that's a tricky one. Basically, there is no real analogy for what occurred here. We can talk about, and there's lengthy guidance about stock splits, but these aren't stocks, are they? So there are a few ways to approach this. One of which is if I receive a forked coin, I have immediate income on that day. And then that becomes my basis, and then I have a gain or loss when I dispose of it. I don't buy it. Okay? I don't buy it. And I'll tell you, hear me out. I'll tell you why. There were such large timing differences for when people actually received their Bitcoin Cash. The fork itself actually happened, was it August? Am I right on this? Yeah, August last year. Well, when did Coinbase users receive their Bitcoin Cash? Anybody? January, and then they had that whole situation where their exchange didn't really quite work yet. Okay, so the event that triggered this happens in August, but yet no one actually took possession of these in any sense until January. I think it's exactly. Facts and circumstances vary quite widely. If you were using Coinbase as a custodian, in essence, you didn't get the Bitcoin Cash until January, okay, and they did a snapshot, okay? Other exchanges handled it differently. Kraken gave you the coins right away, okay? If you control the private keys for your wallet, you can do some magic, and there you've got it, okay? Again, the facts and circumstances varied widely, and in some cases, the fork occurred in a different year than the year when everyone actually received their Bitcoin Cash. So, what's the simple way to deal with it? You have a capital asset with a zero basis. Okay, and that seems to me the simplest way to deal with this. When did you get it? Let's say you held your private keys and then you did some magic and now you have your Bitcoin Cash in 2017. It kind of, all right, so now you're going to probably get into what's the holding period, right? Yeah, again, the scenarios we could go on, okay, because it gets rather tricky with that. Yes?
Can it just be treated like a stock split? Not a stock split, but when you have a spin-off of a company, when you have a spin-off, if you own the headquarters company, then suddenly they just give you extra shares of this company that you never had before. The values change for each of those stocks. You can decide, I want to sell off the headquarters company because all the value was in the spin-off, or I want to keep this, I want to sell off the spin-off because it's crap. Then just treat it like you would a stock.
Can you allocate this is essentially what you're saying. You're saying, so I have Bitcoin, okay, so let's say I've got 10 Bitcoins that I bought a long time ago and I paid $100 each. Okay, so I have 10 Bitcoins and I know what I paid for those. Okay, and then they're in my wallet and then I do something and now I have 10 Bitcoin Cash in addition. Okay, I still got my Bitcoin. I know exactly what I paid for my Bitcoin. Now I have this new type of property. Okay, well, but why would we move the basis from the original property if we still got the property? Not to mention the fact that, frankly, from a software perspective, that would be really hard to figure out because it's difficult enough to deal with 5,000 different transactions on 6 different exchanges without changing the cost basis for something in mid-year. So I think, frankly, it would be mathematically very challenging to do an allocation. But hey, look, if you're a great data analyst, I mean, we could talk, but you got to demonstrate. So, yes.
Can that be considered like a gift, sort of?
Who's giving the gift?
The split.
Who provided? I mean, Satoshi. Like who? Sorry. All right. Sorry.
Well, it came from the magical infinite split, right? So, what's your basis for that?
I don't think that this is a gift. If a capital asset is gifted from one person to the next, I give you stock that I paid 10 for. Now it's 100. You get my carryover basis. Okay, my original price would go to you, and then when you sell it, you use my original basis. But I don't think that this is a gift. I mean, there's no they. So.
My real question is, so master nodes, right? They generate income.
Talking about Dash.
Let's say Dash master node, perfect example.
Mm-hmm.
You earn income every day from holding a certain amount of coins.
Mm-hmm.
And then, similar to mining, you're mining and generating income. Are those two compatible or two separate things from the income you're earning? Because technically, a master node could be considered a giant miner that's making you income every day by holding it.
Mm-hmm.
Some of the expenses of electric, cost of equipment, this, that, and the other thing.
Mm-hmm.
How would you deal with those two?
Yeah, well, we're with the master node, we're just talking about a specific. By the way, how are we on time? 5 minutes. Oh shit. Okay, so I'm gonna I really want to whip you some of the things. Yeah. So let's table that, but I got 5 minutes left. Okay. Hey, taxation of ICO tokens. All right. So we were talking about like kind before, which I say doesn't apply to crypto. So let's say you have one Ether with a cost basis of $100. Today it's worth $1,000. You exchange that one Ether. I'm giving you 10 Daniel coins. You sent the ETH to my smart contract. Wait a week, you get my new tokens. What happened? You made a $900 capital gain. We look to the USD value. You have a sale of $1,000 less your original cost. You have a $900 capital gain. And then that $1,000 cost basis is divided from the 10 tokens. Reality is much more complicated, but that would be the basics of this. Remember before I was talking, someone mentioned about foreign exchanges. It's critical that you file any necessary foreign bank account reports or deal with foreign tax issues. The fines are large. It's kind of a pain to deal with this. So this is a critical factor. Okay. Foreign bank account reports, the filing threshold was for over $10,000 in all foreign accounts, foreign financial accounts. It's a $10,000 penalty if you get popped for not doing this when you should have. Unequivocally, without a shadow of a doubt, if you have USD or fiat held on a foreign exchange, that cash should be reported on an FBAR. Does the Bitcoin itself need to be reported? IRS guidance has been scanty. The simple answer is yes, report it, take a conservative approach. Who wants to, deal with that type of thing? Okay. And sort of to wrap up here, because we had, I just kind of want final notes, is being your own bank, it's difficult, okay? The IRS needs USD values, but the exchanges don't give us 1099s, okay? Particularly a foreign one, you're going to get a CSV, which states the what timestamp, the currency pair, BTC to whatever, or whatever to whatever, okay? Those are our records. Every exchange has their own format. The exchanges don't always provide good records. They get hacked. They disappear. So it's easy to transfer crypto around, but it's a lot harder to keep track of it. So kind of in closing, I can't emphasize the importance of keeping good records. If you're trading on exchanges, make sure you download your histories on a regular basis, particularly when something big happens or something weird. Like a change split or something of that nature, because who knows, that exchange may not be there tomorrow. Hopefully you're not keeping your tokens on exchanges, et cetera, your call. But that's actually all I have to say. I want to thank everybody, and if you have any other questions, I think we got a couple minutes. 2-minute warning or 2 minutes? All right. Yes?
So how would IRS ever track the the values of the
Mhm.
coin for so many transactions.
They have no idea I use software to determine that.
$50 instead of $500 from
Mhm.
1,000 trades, and everybody does like. I mean, how would IRS ever know?
This is largely voluntary reporting that we have right now. That's the answer because 1099s really aren't being issued. But the fact is, we've still got the obligation to report all of these. I'm 100% convinced we were going to see further regulation of the fiat on-ramps to the cryptocurrency ecosystem in the U.S. We're just not there just yet. Yes?
So let's say hypothetically you get hacked, somebody takes your bitcoins,
Mhm.
a transaction to like Zcash,
Mhm.
and then it goes to a private address. Are you responsible for that transaction that happened?
Well, wait, hold on. So, but someone stole your Bitcoin. Is that what you're saying?
Yeah.
So, is it a hack on an exchange, or it's just like a man in the middle, or one or another? You had Bitcoin, someone stole it, right? Well, because the possession of this is really dependent on the private key for that. If someone steals your Bitcoin, you're absolutely not responsible for anything that happens after that or what they do with it. But what you do have is a loss. And the question is, how are you going to report that on your return? Are you consider that a theft or casualty loss, or are you going to write off as a capital loss? This was a big deal for some people in 2016 after the Bitfinex hack, when a lot of people got, what is it, like a 36% or so haircut, right? And then they were are we out? Oh, okay. Mike went away. Mike's off. Is it? Oh, okay. Now we're back. So, theft loss or capital loss? Okay. If it's a capital loss, then we have a sale of the Bitcoin for zero, and the loss is the original cost basis. So if you paid $1,000 for Bitcoin, someone hacks you, it's gone. You have sale for zero, cost basis $1,000 loss. Okay. If this is considered a casualty or theft loss, the results are a lot crummier, because in order to take the loss, you can only deduct the excess of 10% of your income. So most people, thankfully, when they suffer a loss like that, it's less than 10% of the income they earn that year. These rules are essentially designed for things like flood. Your house is washed away in a flood, and the casualty loss deduction will be able to pick up the difference, for whatever you weren't insured. Maybe somebody in the back. I see a hand.
Unfortunately, we're out
We're out of time.
Yeah.
Thanks a lot, everybody.
Daniel Winters, Global Tax Account.